All right, students, so we're back for our second week of virtual learning, and we are going to be finishing up our 2-week learning session and unit on taxes and income. So where we left off, we kind of talked about the three types of taxes. You have federal income tax, state income tax, and FICA. We discussed that in our Zoom session, and then you guys had a whole bunch of really depressing numbers to look over from the state and federal budgets that we to see where your money goes when they take out those taxes. So hopefully that wasn't too overwhelming for you. And remember, that's I think the United States is at like 400 million people, so that's spread across 400 million people. Some making a lot less money than maybe you or your family, and some making a whole lot more money than you and your family. So that's what we're going to kind of transition into talking about is income and tax brackets. How do you know how much tax you have to pay? So every citizen in the country has what's called a tax burden. So based on the income that they bring in, there is a certain amount of tax that they owe. And what the government has done is they set up what's called, tax brackets, okay? So tax brackets, you're going to see a bunch of information. I'm going to have it posted on Edmodo, and it's going to say something like, if you make this many dollars, but not more than this many dollars, and if you make this many dollars, but not more than this, that is what's called a tax bracket. So I believe, if I remember correctly, if you make under $9,700 a year, you don't owe any taxes. If you make at $9,700, you owe 10%. And so there's a fixed amount, and then anything over $9,700, there's like a percentage and a way that you calculate it. It's really not that difficult to figure out. And if you don't like doing the math and running the numbers yourself, you can always just type into Google, tax bracket calculator or something, and it will tell you what tax bracket you fall into and then what your tax burden should be for the year if you just are not doing any kind of write-offs or deductions, which we will talk about in a minute, okay? Tax brackets change with each, sometimes by year or by administration. So whenever we elect in a new president, one of the things that they usually campaign on is taxes and where money is going to come to run the country and the government. And so right after President Trump came into office, he pushed through, and the Senate and the House, they pushed through a new tax, like a tax reform. And so we are now under that tax reform. And so that's one of the most frustrating and difficult things about taxes is that it's always changing, right? And not only is it always changing, but there's all these different kinds of taxes like we talked about last week. So sometimes you start to get used to what you owe, and then it changes on you. And sometimes that's for the better, and sometimes that's for the worse. So it just depends on the administration, but it usually doesn't feel good either way, right? So you have a tax burden, it changes, and then every year when you go to file your taxes, you can do what's called write-offs, okay? And so if you looked at your 1040 like you were supposed to, here's the 1040, you'll notice in this little box right here, there's some information, and if you have that with you, pull it out. It says standard deduction, okay? So a deduction is different than a write-off, so I'm jumping ahead a little bit, but I'll set this aside then. Write-offs are things that you are allowed to deduct from your income based on certain either legislation that's been passed or on the type of job that you have. So, for example, I've told you guys that I'm an independent contractor. None of my jobs, I have 3 right now, none of my jobs am I an employee at. So I don't get those FICA benefits of the 50% FICA tax coverage. I pay what's called a self-employment tax that covers that. But there are some benefits to being an independent contractor. So I can write off the cost of my car because I use my car to get back and forth to work. I can write off the cost of my cell phone when I purchase one, and then my cell phone bill because I use my cell phone for over a certain percentage amount of the use of the cell phone is for business purposes. I can write off when I need to buy a new computer. I can write that off because the percentage that I use the computer is enough to qualify as it being a business expense, okay? Some other things that you're allowed to write off as a private citizen are charitable donations. So any donation that you make to a 501c3 nonprofit organization organization. For example, the Red Cross, your church, your tithe, when you donate money to, or when you donate goods to like the Salvation Army to resell, you can write those things off. Another thing right now that you're still allowed to write off is what's called mortgage interest. So any interest that you pay on your mortgage loan for your house, none of you have one yet, but your parents do, right? That is a tax deduction. And then right now, still, we can write off our state income taxes against our federal taxes. So what does that mean? What does it mean to write something off? So just as an example, say that you make $10,000 a year. It's just a nice round number, okay? And so you should be paying 10% of that. So we're just going to say, as an example, $10,000 income, you should be paying 10% of that. 10% of 10,000 is 1,000. So you should be paying the federal government, $1,000 in federal income tax, okay? But you supported your cousin's mission trip to Bali, I don't know, this last year, and you donated $500 towards that mission trip. Because it was given to a 501c3, you get to deduct $500 from your gross income. So that means that now the government only considers you as making $9,500 that year. So you only owe 10% of $9,500 or $950 instead of $1,000. So a lot of times as you start to get older and your income level grows and your investments grow and you buy a house and you're working full time and all those things, you start to realize that there are certain ways that you are legally allowed to pay less taxes. And it's a whole very interesting world to get involved in, and as you start to get older, it's really good to have what's called like a CPA, a certified public accountant, or somebody that is really wise in taxes, or you just have to do your homework. For 1010, we don't get to write things off because we're a nonprofit. We don't pay taxes because we don't take in a profit, but I do the taxes myself, so because we can't afford to hire an accountant. So I've learned a lot about tax law and stuff, and I've learned a lot about a lot of things by doing this. But anyways, so that's what a write-off is. It's when you, something that's legislated as being able to be deducted from your gross income so that you pay less taxes. And so then tax credits. Let me see my notes. That one's escaping me. Tax credits. Oh, okay. So tax credits. You get tax credits for being married. You get tax credits for having children, okay? And so that's where that standard deduction comes in. The standard deduction, back to the little box on the 1040 form, okay? If you read that with me, it says standard deduction for single or married filing separately. So if you are married and filing separate tax returns, or if you're a single person, you get a standard deduction of $12,200. That means that the first $12,200 that you make, you do not pay federal income tax on. Okay? If you're married and filing jointly, that doubles, okay? So then you only pay the first $24,400 that you make, you don't pay any income tax on. And then if you're the head of the household, which is defined, I'm not too familiar with this, but I think it's like in the situation where maybe it's a single mom or a single dad, and they are the sole provider for the household, and there's somebody else living in the house. Or say you have a single person who's housing their elderly mother or father, they get an extra tax credit for that. And so their standard deduction, instead of just being the $12,200, it goes up to $18,350, okay? And so you can see there, that's what the government lets us make without paying any taxes on it. And then up and beyond that is where then you find your tax brackets, okay? So that's called a standard deduction. Now, one of the things that when President Trump and his administration, when they sent through this new tax reform law, that standard deduction went up quite a bit because they were trying to make, or so they say, they were trying to make filing your income taxes a lot more simple, that it had gotten, there were so many laws and so much legislation that it was starting to get too difficult for people to figure out how to file their taxes. And so they were trying to kind of discourage write-offs, and were trying to up the standard deduction so you could just do one sheet of paper like this 1040, and send it into the IRS. My family, because of my income, and then my husband a lot of times has side jobs too on top of his, or in addition to his full-time corporate job, he does side work as well. And so our taxes are quite lengthy because of all the write-offs and stuff that we do because of being business owners and contractors. And so our taxes are usually like this thick, but we pay somebody to do it, and it's kind of worth it to pay somebody to do it. And anyways, it's someone my husband's family's worked with for like 30 years because his family owns businesses. Anyways, so now we're going to move on to income, okay? And so just like taxes, there were 3 kinds of taxes. And now we have 3 types of income. You have earned income, you have portfolio income, and you have passive income. And so these are the 3 types of income that the IRS considers when you file your taxes. The earned income is the money that you make from a job. So you go to Chick-fil-A, you have a job, you go to Miguel's. Guys, I just had another Miguel's burrito. Can you believe that? So the earned income is the money that you make from going to your job, and that is the amount. That amount for your earned income gets taxed the highest of any of your types of income. Okay, and then your portfolio income is the income that you make, and it's taxed at a high rate as well, because it's money that you make on investments and stuff. So say you put, not recently, say you put money in the stock market and you make $10,000. It's called a capital gains tax because you're making money on money you already have. It doesn't make any sense why it would be taxed so much more. But portfolio is money that you make on money. And then passive income, I'm just going to read this definition because this is new to me. I didn't know this. I knew about earned income and I knew about portfolios, but I didn't know about passive income. And it's defined as when you are taxed on things that require little effort. So like real estate investments, okay, intellectual property, businesses, maybe where the owner owns the business, but he's not involved at all, or she's not involved at all. And so they don't have much investment in it personally, but they own the business. So say like, I own a clothing company, which would be really awesome. I own a clothing company, but I just kind of check in every once in a while, but I have everybody that runs the company I've hired, and they just take care of everything, and I just kind of make the money from it. That's a passive income. Real estate is a passive income because you don't really do anything for that value to go up. It's kind of based on the real estate market in your area. And just so you guys know, you are able to sell a house every 2 years without paying any capital gains tax. So say you buy a house, you wait 2 years, the value goes up $100,000. You get to keep that money and you don't have to pay the government any tax on it, which is why a lot of people get into real estate, because it's a way that you can make money and avoid a lot of taxes on the interest or the capital gains that you make while you have that investment. Whereas if you invested in the stock market and made $100,000, you'd be paying what's called capital gains tax. And then also one of the things that I believe is in your portfolio income is things like estate taxes and stuff too. So estate taxes are taxes that you pay when you inherit money. So it's kind of sad, like your grandma and your grandpa worked their whole lives, they save, they're really good with their money, and then they want to leave something to their grandkids and their children when they pass away, and the government takes a bunch of it, which is kind of sad, but it's just the world we live in. So it takes money to run the country, and it's got to come from somewhere. So remember, 2 things are certain in life: death and taxes. And anytime you see something on a ballot when you start voting when you're 18 and it costs money, it's got to come from somewhere. So just make sure it's something that you want being taken out of your paycheck every week or month. All right, and so one more thing to talk about with your income is that you have your gross income and your net income. And now this is something that I've struggled with my whole life. I can never remember which is which. So gross income is the income that you make before taxes or deductions. So if you're making if you get offered a job and your salary is $24,000 a year, your gross income will be $24,000 a year, okay? That's the salary, the base salary. Or if it's $12.50 an hour, your gross income is $12.50 an hour. Your net is after taxes and deductions. So if somebody asks you what your net income is, it's what's actually on the check that gets deposited into your account or the check that gets sent to you each week or two, okay? So gross before taxes and deductions, net after taxes and deductions. Now, what do I mean by deductions? So deductions are things that get taken out of your paycheck that you either authorized or you haven't, or it's just law. So deductions might be federal, state, and FICA income taxes. It might be your health insurance benefits. So you may sign up for a health plan, and when you sign up for it, you know that it's going to cost you $52 a pay period. And so that's going to get taken out. And then say you also want life insurance. And so you sign up for life insurance, it's $13 a pay period. So they take that out. And then also deductions, some other deductions would be if you look at your W-4, so we're going to transition to that. If you look at your W-4, there's some things on here that are considered deductions, and I don't want to go too far into this right now because that's what we're going to do together on our Zoom session. I asked you to fill these out. You will not be turning these into me. I just wanted you to practice so that if and when you get a job, you know what it's going to ask you, and you go into that process of filling out your human resources or HR paperwork with confidence, and there are things that you've seen before so that you're not thrown off. That's part of what this class is supposed to help with, is really preparing you for employment and financial side of life that you're going into as young adults. So I'm not going to obviously have you turn this into me because it has sensitive information on it, like your social security number and stuff. And so I won't collect it, but we will talk about what's supposed to go in each box when we meet together on Zoom. Hopefully you watched this before our Zoom session. If you didn't, it's fine. I'll probably say everything again anyways, like I always do. But so this week, taxes, income, Zoom session, W-4 review, and then you're going to get another one of those task card activities that we've been doing over the last part of this last semester, and it's going to be on your paycheck. So how to read your paycheck and how to analyze things, and it's going to have some basic math questions because we do need to be doing some basic math in this class. And so hopefully you guys are doing well, and I miss you all so much. And don't hesitate. I think I got one comment on my last video, and it warmed my heart because I just miss you guys so much. I'll just tell you this right now. This is Friday. I'm recording this on Friday in anticipation of next Wednesday. And I had a really great meeting with some of the teachers this morning, just kind of reflecting on what happened 2 days ago on Wednesday, which was our first virtual day. And the day went off well, and I hope you guys were blessed by it. I hope you know that your teachers love you so much. But this morning I had that meeting, and then today I came down here to record some videos because it's a little bit easier for me to think here. And I went to go get something out of the storage room, and I walked through the fellowship hall, and my heart just sank. It was so quiet and empty. And so I hope you guys know how desperately we miss you guys and how desperately we just want to still love and serve you guys through this time. I hope you're well. Sorry I'm ranting, but we do really, your teachers love you. And I'm confident that you all feel that. So see you guys on Zoom soon.